All right, picking up from the last video, this is part 3 of the Anglo-Saxon model. We left off talking about institutional investment in the U.S. The U.S. has a lot of money that flows to corporations through these institutional investors. These are companies that represent either pension funds or mutual funds, and many times these companies are dealing with billions of dollars of savings that can be used to fund corporate expansion. So it's a large source of funding for corporations. Most people in the U.S. don't buy stocks directly, but they might own stocks through their company's pension plan or through a mutual fund that maybe they purchased in a 401k or an IRA or something like that. In the US, there's corporate incentives that help align employee and management actions with the shareholder's goal. There's always this principal-agent problem we face with corporations where the principals, who are the shareholders, they want maximum profits, but the agents are the employees and the managers that actually are put in charge of generating those profits. So there could be this problem where they don't really pursue the same goals. And one way of aligning those goals is to tie the employee and management compensation to the actual profitability of the company, the shareholders' goals. One way is through stock options. This is where a company gives the employee the right to buy a designated number of shares of that company at a specified price. So just as a simple example, let's say Ford Motors gives its employees the right to buy 1,000 shares of stock at $50 a share. That would be what we call the grant price. That means that for some period of time, usually a year or two, that employee would be allowed to buy shares from Ford at $50. Well, if the price goes up to 60 or 70 or 80, then they would want to exercise those shares so that they could buy at 50 and then sell at the higher price and reap those benefits from the stock options. Stock options can be a very powerful incentive because employees then have a motivation to do the things that raise profits so that they raise the value of the company in the stock market. Profit sharing is another type of corporate incentive. This is where you tie the employee's compensation to the actual profit of the company. And this is about as direct as you can get with the shareholders' goals. If the shareholders profit, then the employees profit as well. And then there's tournament pay. This is also common in the US, where you give the CEO a really high income so that the lower level executives in a corporation, maybe the vice presidents, or depending upon the company, the presidents, they have a strong incentive to get that CEO position. So they work extra hard to win that tournament. The term comes from games or athletics, like in golf, where the top prize is a multi-million-dollar prize, and the lesser, the second place, third place, fourth place winners get something significantly less. So that causes them to work extra hard to want to win that tournament. So corporations in the U.S., especially Fortune 500 companies, are often set up with a compensation for the CEO that is 10, 20, even 100 times what the lower executives would get paid. Moving on, the U.S. model is about competition. It's a highly competitive environment. We do have some of the biggest companies in the world, but don't confuse largesse with less competition. For example, Walmart is the largest company in the world in terms of annual sales, but Walmart faces a lot of competition. Whereas you could have some small companies, you could have a dry cleaner, a mom and pop dry cleaner in a small town, and they're the only dry cleaner that has a virtual monopoly. So don't confuse size with a lack of competition. Competition means there's other options for the consumer to consider, and that's going to bring about a lot more efficient outcomes, better quality products, lower prices, more cost efficiency, that type of thing. So we tend to like competition, and the US brings about a pretty competitive market. One of the ways that we do this is we have the government involved. The Federal Trade Commission and the Department of Justice enforce what are called antitrust laws as a means of ensuring that competition stays robust. These departments and commissions are given the jurisdiction over acquisitions and mergers. They're given discretion in preventing companies from coming together. I remember a while back they said that Staples and Office Depot were not going to be allowed to merge. There's been other companies that have been precluded from merging. And then sometimes they let big companies come together. CVS and Aetna in the past couple of years formed what would be the biggest merger in U.S. history. The competitive environment in the US means there's limited market power. And when you think of market power, I want you to think of two things. Monopoly, obviously, right, because that would mean one firm on the selling side of the market, but also think of monopsony. Monopsony means one buyer on the buying side of the market. Both monopsony and monopoly create a less competitive environment. That's just to say that in a competitive market, we need a lot of buyers competing to buy the good, and we need a lot of sellers competing to sell the good. And what this does is it keeps prices moving, correcting surpluses and shortages, and helps keep the market much more efficient than would otherwise be possible. If you wanted an example of a monopoly, the closest you would get, aside from those small geographical monopolies like the corner dry cleaner, would be maybe a utility company like SDG&E, where they have strung power lines all over the city, so there's no incentive for another provider of electricity to come in and compete with them. But if you want an example of a monopsony, then you would look at where there's a sole buyer of a good. And one of the best examples you would get of this is in healthcare, where when it comes to senior citizens, because of the program Medicare, the government is effectively the sole buyer of healthcare for seniors. So we do have some monopsony, we do have some monopoly in the US. We also have these agencies to try to proactively prevent this kind of market power. But generally speaking, the US is a pretty competitive model. And to test this, just look at everything that you own, everything you've bought, and ask yourself, how many different vendors did you have as options to purchase that from? And if you can count more than a few, then there's probably a decent degree of competition in that environment. Capital markets. Capital markets in the US tend to be impersonal, objective. The capital is supplied by outsiders, maybe banks or investors trying to create a portfolio, as opposed to capital coming from families or from people within a company. So corporations, for example, when they want to get capital, and we mean money here, right? Capital in terms of money, they either go to banks or they go to these outside investors. Sometimes these are called arm's length transactions, meaning that there's no personal connection between the people supplying the capital and the firm that's getting it. There are three general ways that a company can get capital to grow and invest and so forth. The first is they can go to stock markets, issue new shares of ownership in the company. The second is they can go to bond markets, issue bonds, and essentially get loans directly from people to grow the company, or they can go to a bank and borrow the money. In the US, there appears to be a preference for stock markets, and we can see this through what's called market capitalization. The market cap of a specific company is the total value of all that company's shares of stock at a given point in time. So for example, if you were to pull up Apple, you'd find that their market cap is close to or over around, let's say, $1 trillion. That means that the value of all their company stock at a given time is around $1 trillion. Now, you would do the same thing for all companies if you were looking at kind of the aggregate US market capitalization. You just add them all up. And the US does have a high market capitalization compared to some other countries that we'll see later on. This suggests that there is a preference in the US for stocks over bonds and bank loans. Some countries it's just the opposite. But in the US, stock markets are very attractive to savers and investors, and that's where corporations really go to get the funds to grow. To get those funds, the corporations enter what are called primary markets, which is where they issue new stocks and bonds. You may have heard of an IPO, an initial public offering. So if a company like Walmart wants to get funds to go and build a new warehouse, they might do an IPO, which would be selling stock or bonds to investors so that they can then get the money and go off and expand. The secondary markets are where existing shares of stocks and bonds are sold. So after the initial public offering, the owners of those stocks or bonds, the ones that actually gave Walmart the money and now have these paper assets, stocks and bonds, they can trade those assets amongst themselves. And that's usually what you refer to when you think of the day-to-day stock market. IPOs are, infrequent, but secondary markets are happening in real time, kind of 9 to 5 every day. Underwriters. An underwriter is an organization that issues an IPO. Sometimes they actually buy the stakes in the company themselves. Goldman Sachs, for example, is one of the more famous underwriters of corporate stocks. So if Walmart wants to issue new shares of stock in order to fund expansion, then it will go to Goldman Sachs and it will ask Goldman Sachs to act as the underwriter. Goldman Sachs then will organize that initial public offering, because that's their business, right, to create financial instruments and then sell them off. And in many cases, they'll actually do a firm commitment, which is where Goldman Sachs might buy the stock, funding Walmart up front, and then they'll go and sell the stock in an initial public offering, hoping to get more than what they paid Walmart. Regardless, underwriting is a big part of banking in the US, and it goes hand in hand with having a lot of market capitalization, right? A lot of stocks being issued by companies, and those companies needing financial agents to help them organize this system. Securities and Exchange Commission, the SEC, you may have heard of this. The SEC regulates the initial public offerings and secondary markets in the US. It's fair to say they regulate just about anything to do with stocks and bonds. When there is a new stock issued, an IPO in a primary market, the SEC requires what's called a prospectus. This is a formal, informative document that has to be filed with the Securities and Exchange Commission for a corporation issuing stocks or bonds to the public. In essence, it's a way of communicating to future investors the kind of expectations of this company, because the company's not around yet, right? If it's an initial public offering, the company doesn't exist in terms of being publicly traded. So you got to get the people the information so they can determine if it's a good investment or not. And they use GAAP, which is Generally Accepted Accounting Principles accounting. GAAP is a method of accounting that ensures consistency when you're looking at one company versus another in accounting. We also, through the SEC, require full disclosure. Full disclosure means that any publicly traded company must release all information about the company. You click on this link, EDGAR, it will take you to the SEC website. And this is an economic database that allows you to get the income statement, the balance sheet, and a whole host of other financial documents that are submitted regularly by publicly traded corporations. So there's no secrets in terms of their financials. Full disclosure is part and parcel of having a healthy capital market, because people need the information in order to feel confident that they can invest in these stocks and bonds and fund these companies. Another way of putting it is you wouldn't have a strong market capitalization and a lot of access for corporations in terms of capital if you didn't have this kind of support. U.S. stock exchanges, there's two big ones. There's a New York Stock Exchange and there's the NASDAQ. The New York Stock Exchange is the oldest. That's the brick and mortar exchange over there on Wall Street in Manhattan. And then there's the NASDAQ. That stands for the National Association of Securities Dealers Automated Quotation System. Don't worry about memorizing that, but just keep in mind that this is not a physical exchange. This is a computer-based exchange. Came around in the 60s. A lot of tech companies in this exchange were on the New York Stock Exchange. It's, older companies, more manufacturing, more heavy industry, that kind of thing. So there's two major exchanges in the US. That's pretty much it for this video. I'll continue on with the US model characteristics in the next video to come. Thanks.